Chief Investment Officer of Pillow Investment. Alpha Ba is back. This time we're diving into the current and forecasted state of the global economy. Alpha, thanks for joining me.
Thank you for having me. Nice to be here.
Now, according to the macro forecast from the IMF's World Economic Outlook, which released its findings in April, what is the outlook for the U.S. and Canadian economies?
So the IMF is looking at about inflation being sticky and suboptimal GDP growth. If you look at the numbers themselves, for the U.S., the IMF expects 1.8% real GDP growth for 2025, slowing down to 1.7. So 1.8 going to 1.7. For Canada, the IMF is looking at 1.4% in 2025 GDP growth, going to 1.6. So you got GDP growth below 2%, and inflation about 2 to 3% for Canada and the U.S. this year in 2025, going down to 2 to 2.5%. So elevated inflation with lower suboptimal GDP growth, which reeks of stagflation, which is very dangerous for companies.
Now, what were some of the other highlights of your macro analysis?
Yeah, so I've looked at the unit labor cost analysis, which is not part of the IMF. It's kind of our own analysis. And unit labor costs are really important to us because you want them to be low. If they're high and rising like they are right now, they are a headwind to margins. And what we're seeing globally in the developed countries is unit labor costs going from 2 to 3% pre-pandemic to about 3 to 5% now. So you have a 3 to 5% headwind to margins. If you drill into the numbers, Canada went from 2.9% in 2019 to about 4%, just like slightly below 4% in 2024. The U.S., same thing, went from 2% in 2019 to 3.1% in 2024. And Germany went from 3% to 5%. So that is a headline to margins. In a slowing economy, you have unit labor costs going up. So that means you have to focus more on maybe companies that have a strong, like a quality strong enough to be able to pass on those extra costs to customers. That's what we call pricing power.
And then for companies that maybe can't press those costs on, those rising unit labor costs on to customers, what does it look like for them? They'll just decrease their margin, and what does that look like to the company's bottom line?
Yeah, so those companies that face higher costs, but fixed prices or at least a lack of pricing power, they would have to eat the margins. They would have to eat the higher costs, and obviously that will contribute to lower margin and lower EPS growth, and down the line potentially lower stock prices for those type of companies.
Yeah, and just off the top of your head, are there companies in particular that you think would fall into, say, companies that can still maintain their growth while passing on, those costs to the customers, and then companies that are going to have to sort of reduce their margins? I
mean, if we look at Dollarama, we think Dollarama can pass on any higher cost to their customers because they have pricing power. That is not the case for commodity type of businesses where you just have to eat the lower cost because you have an undifferentiated product.
Let's just shift to your thoughts on the Canada's response to the tariffs and Prime Minister Carney's plan. What do you think about that, certainly as how it also affects the global economic stage?
Yeah, I think the Canadian Prime Minister's response to the tariffs are a three-legged stool. Number one, the administration want to free up interprovincial trade, which acts like a 7% tariff on goods within Canada. So you want to create a pan-Canadian economy rather than a fragmented economy in Canada. The second element is to invest in infrastructure, and we think that's very positive from a productivity standpoint. And third, but not least, is the diversification of the trade relationships, east and west, east towards Europe and west towards Asia, which is a very dynamically which is a very strong economic power, which is growing very fast relative to the rest of the world. So we think that these three policies bode well for Canada. And another thing that is important to mention is that I think that the U.S. tariff policies will sooner or later prove detrimental to the U.S. itself. One example is the aluminum tariffs that the U.S. administration raised substantially on steel recently. If you look at the power used per facility, smelters use or require 300 to 900 megawatts, relative to data centers requiring 10 to 100 megawatts on average. Therefore, you're going to divert capital from highly productive and future-oriented data centers to something that is less efficient and less productive from an economic perspective, smelter, because smelters obviously consume 10 to 12 times more power than data centers. So I think that's an example of a negative externality of tariffs that the U.S. administration will have to contend with.
Yeah, perfect. Now, is there any updates from your global valuation analysis?
Sure. So if you look at the valuation, around the world, what we see is that Canada has the lowest expected growth rate in terms of EPS, earnings per share, over the next year. They are expected to grow at 8.4%, and for that you're paying about 16 times earnings. The U.S., EU, Germany, China, India, all these guys are expected to grow anywhere between 12 to 14%. But for that growth, you're paying a very steep multiple in the U.S. You're paying 22 times, which is double what you're paying for China and about 50% higher than what you're paying for Germany. So what we're seeing is a bifurcation around the world where, again, Canada is slowing down, but it's a bit expensive. The U.S. is growing decently, but it's very expensive. Germany and China are growing decently relative to the U.S., but they are way cheaper. And that has led to a bifurcation in stock returns over the past 6 months. Year to date, we're seeing Canada grow by 14%. The EU and China growing by 15 to 30%. So basically, the EU is up 25%. The benchmark for the EU is up 25% year to date. The benchmark for China is up 17% year to date, and the U.S. is up 2%. So the U.S. has been a very strong underperformer year to date, after being a very strong outperformer over the past 1, 3, 5, 10 years. So something has changed for investors this year relative to the U.S. versus the rest of the world.
So there's a shift, and a shift looks like more into the global stage.
There has been a shift indeed away from the U.S. and into the global. The key question now is, will that shift stick for the next year, 2, 3, 5 years? The U.S. remains an exceptionally dynamic economy with very, very strong companies. But U.S. economic policy has gone from a stable anchor in the world to a destabilizing force in the world, and that has to be accounted through lower multiples and higher yields.
Now, just as sort of rapidly or swiftly that it shifted, which it seems that it happened quickly, can it also shift the other way?
It can, obviously. I guess there's good and bad news. The good news is this shift stems from the policy of the U.S. administration, which can shift back. We've seen already that the U.S. president has stepped back when the bond market got a bit more touchy. When we saw bond yields go up, the dollar go down about a month and a half ago. Then President Trump stepped from his very high tariff policies. So I think that has reassured investors that at the end of the day, because the U.S. as like the rest of the of the G7 countries have very high debt, they are at the mercy of the bond markets. So therefore, the bond market will not allow politicians to get away with very, very high tariffs. So that risk, I think, is off. Now, even the tariffs we're talking about here, 10%, are much higher than they used to be, 8 months, 9 months, 10 years ago. So that has to have a negative impact, I would think, on the global economy if they stay.
All right. Well, thank you so much for your time. For the Expert Exchange, I'm Karina Robertson, Alpha. Again, such a pleasure.
Thank you so much. Nice to be here.